Good afternoon and welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me in MarketSite is Doug Ellenoff. He's a partner at Ellenoff Grossman Schole, and we are going to look at SPACs and why they are relevant in today's market. Doug, thank you so much for joining me at MarketSite today. Before we get into it, explain to the audience what a SPAC is.
My pleasure, and thanks for the invitation
Thank you.
today. A SPAC, which is a program which has been around since 1993, so 25 years at this point, is a registered blind pool offering. I prefer to think of it as a single-purpose private equity acquisition vehicle, but it's a public offering where investors entrust a certain sum of money, anywhere from $50 million to several $100 million, to a well-known, seasoned private equity or venture capital sponsor.
Right, and why would you say it's relevant in today's market?
Last year, as an example, 20% of all public offerings were SPACs, so I think that by itself makes it relevant. But what made it come of age is that the most qualified, experienced, and established private equity sponsors in the country have embraced the program, and so that last year, 34 SPACs were completed, raising over $10 billion, and that enabled investors to co-invest with these same established private equity and venture capital investors and participate in those markets.
So what are some of the advantages to investors besides having the participation ability?
Well, for a public investor into an IPO of a SPAC, they have the ability to get a common share and a warrant, and they still have the ability to ask for their money back after the SPAC IPO and prior to the closing of the proposed acquisition. The investor has the ability to say, no, I don't want to participate, or yes, I do want to support the fundamental transaction, the business combination as it were,
right,
and still get an extra warrant. So the economics of it work out very favorably, as well as the risk. If an investor doesn't like the deal, they can just ask for their money back.
So a SPAC is used for raising funds for future acquisitions. Can you discuss what typically occurs when there's a business combination?
Well, a SPAC isn't a public company after the IPO, like any other public company. When it identifies an acquisition candidate, it reapproaches the investors with new disclosure about the business opportunity that they're bringing forth for the shareholders to vote on. So there's a proxy process with a full vote, full disclosure, IPO-like disclosure, so investors at that time get to decide if they like the proposed business combination that the sponsors have brought to them.
What's the difference from SPACs, let's say 10 years ago, and what you're seeing today? What are some of the trends that are out there now?
That's a question I really appreciate your asking. The program's evolved. All programs start in one way, and they respond to market negativity or tensions. So many years ago, there was some regulatory concerns, but now that those concerns were unfounded in many cases, most cases in point of fact, the commercial people have responded to whatever commercial concerns there may have been. The program nowadays, the commercial terms have private equitized is the way we like to describe it broadly. So the dilutive impact of the structure has been reduced. The time periods for getting through regulatory review at both the time of the IPO as well as the time of the business combination have become very normalized and may be advantageous from a private company's perspective to get to the public markets. Those are two of the major changes, as well as the way we test the waters with the business combination at the time of the acquisition enables both the private company and the sponsor to better have greater transparency with institutional investors to see if they really like this deal at that price and want to see this deal proceed.
Well, we tend to see more private equity SPACs now than we have in the past. Why do you think that is?
The economics for private equity sponsors is significantly better than what they might get if they went to endowments for the same money to acquire that same company. So that's probably the single greatest reason, as well as some of the negatives that I mentioned earlier have been eliminated, so their ability to participate is greater. When you look at the number of public companies in this country that has dwindled from many hundreds in a given year down to last year was 190, of which SPACs were 30 plus. I think that private equity firms recognize this as a legitimate alternative way of getting a private company public in an efficient manner. And not only has that been the theme, as you're pointing out, But venture capital firms are starting to see that this may be a good way for some of their portfolio companies, not necessarily the unicorns, to go public. And so Tim Draper, who listed on Nasdaq, did his SPAC here, the Draper SPAC, and there was one other, and we have several other in queue, so I think that's a trend. You today listed a business combination of an energy deal, which was a business combination of a SPAC. Energy has been a theme within SPACs, and I think we're also seeing the emergence, for the first time in over 15 years, of real estate opportunities or hospitality-related businesses as SPAC-able.
All right, and to recap and to wrap up, so SPAC raises capital for future M&A. Can you touch on those assignments or the business combinations that occur post-IPO?
Say it one more time, I apologize.
So can you touch on the assignments or the business combinations that occur after the IPO or after the SPAC is listed?
The assignment from our perspective or from the sponsor's point of view is they have to pursue their deal flow, because up until that point in time, it's a blind pool public offering. And then those sponsors that have industry and domain expertise look through their deal flow as it occurs, which is usually dozens and dozens of deals before they select one that they think is appropriate for the public markets. It's right as to maturity, as it relates to corporate governance, as it relates to accounting, and it's at a good value, so it's got the private to public arbitrage, and therefore it can absorb some of the other economics. And that's what sponsors, of which there are 48 currently looking for, deals are looking to achieve, is to find private companies appropriate for the public markets to list on NASDAQ.
All right, well, thank you very much, Doug, for joining us today at MarketSite. Thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.